Hello and welcome to this prologue of the financial transactions unit. It also is probably the prologue of the advanced bookkeeping unit for AAT levels 2 and 3. And this, what we're going to do in this prologue really, is just the double entry bookkeeping element of the unit. And this is because this is the bit that people struggle with the most, and this is the bit that people really like to have explained to them. And we're going to do this sort of foolproof method here. I'm going to call it the paper and cups method in there, though. It's going to make it really sort of take everything back to absolute first principles, make it incredibly simple there, though, and actually you'll understand it. So what we're going to do then is we're sort of sitting there and we're in our unit, and perhaps you've done a bit of accountancy before, or what have you, or you're in the unit and you're struggling and what have you, or alternatively you're really lucky and you've not done any accountancy at all and you've come just to this video straight away. That's probably the best position to be in here. We have things called the accounting equation, we have things called double entry bookkeeping, we have things called accounts, we have things called T accounts, we have debits and credits and all the rest of it. There's a whole load of Java mumbo jumbo there though, and people sort of think, what on earth is this all on about? Have a trying to sort of put it into some kind of framework themselves, and pretty much get a bit lost really. So what we're going to do instead is we're going to sort of work through this from a really sort of simple way. And the problem is though is that this is the most important thing in all of accountancy. So every accountant since the 5th century AD, really, where it sort of starts in India, and every single accountant since that point all the way up to now has had to learn this particular skill that you're going to learn as well. And it is impossible to not learn this skill, or impossible to be an accountant if you don't learn this skill. It's not going to happen in terms of you have to know this, otherwise you can't be an accountant. The problem is though it's taught a very sort of in a very sort of poor way quite often really. If you look on the internet and you see sort of 4-minute easy way to learn double entry bookkeeping, please don't click on it. Run a mile away from it. In there, it's absolute rubbish, and it will just ruin. You'll have to learn it using something like 10 hours worth of unlearning of whatever it is that you see. So it's not an option to not like this double entry bookkeeping. It's not an option to not like T accounts, for example. However, on the plus side, when you understand this and you see the absolute perfection of this sort of system there, though, you'll be really quite thrilled about the whole way that it works. And that sort of binds all of us accountants throughout the whole world. You all do this in exactly the same way. So every single accountant does this thing in exactly the same way. Is a particular skill that we all have, and that makes our profession so valuable. So what we're going to do is we're going to do this in a task in there. And so in order to do this task, and whether you want to sort of press pause or whatever, you're going to need some items. You'll have 3 pieces of paper. Preferably they'll be in different colours. So 3 pieces of paper, preferably in different colours, but just you can have 3 different pieces of paper. That's on A4, let's say A4 paper. We can have bigger ones if you want to. You're going to need a load of cups, cups or jam jars or something to put things into. Okay, so you're going to need about 8 of those, 8 or 9 of those. Get them all ready for yourselves. Some label, you can use labels. I use labels in this. If you've got some, you don't really need them actually. To be fair, you can sort of write on a piece of paper underneath where these things are. I'm going to use some labels in this, and there's some nice sticky labels that stick out, makes it a bit sort of neater, more exciting experience. But you don't really need labels, but I'm going to use them in this. And you're going to need a paper and some pen really. So you're going to have some separate pieces of paper, which we're going to tear up, and you need a pen. Okay, so. Step 1. On the 3 pieces of paper, you're going to write on sheet 1 something called assets, on sheet 2 something called liabilities non-shareholders, and on sheet 3 liabilities to shareholders stroke capital. Okay, so that's what we're going to put on those 3 pieces of paper. Put those on your 3 pieces of paper now, and it should look something like that. Okay, now what I'm going to do is I'm going to take you through what these particular words mean. Okay. So assets. Now the assets are something that is either positive money now, so it's either positive money now, or it's going to create positive money in the future. So it's plus money for the company. So imagine this, plus money for the company. So we'll actually use just sort of mathematical signs really. So positive money now, either now, so positive money now, or positive money in the future. Okay, so this positive money now, the bank account now, we've got some money in our bank account. Let's say there's £10,000 in our bank account. It's positive money now. Okay. If some customers owe us some money, so they owe us £10,000, it's positive money in the future. So that's an asset because we're going to get money coming into our organisation in the future, plus money in the future. If there's a car or a building or a van or a computer, it's plus money as well because we're going to use it to create positive money in the future. So things like this, so assets are either positive money now or positive money in the future. And that positive money could be that actually it's going to be coming in a certain level of money in the customer accounts, or something that's a bit uncertain, but we're actually going to use something to create money in the future. So a car or a building or whatever it is. So that's an asset. Get that in your head first of all. What is an asset? An asset is simply a money flow into the company in the future, or a money flow that's already flowed into the company. That's all that an asset is. So when you're looking through and describe this, is this thing an asset? Is this a liability? Is this something else? Is this share capital? Asset, is it positive money to the company? And this is the important thing, to the company. Not to shareholders, we'll see that later on, but to the company. Is this money coming into the company or money already in the company? So assets is money into the company, money in, positive. Okay. Liabilities to non-shareholders. Okay. So I'm going to do this in the full layout, and that's why I put it in the full layout on piece of paper. So this is liabilities to non-shareholders. Now this is where I think things go wrong within the teaching of double entry bookkeeping. In accountancy, because it's such an old subject, you have a lot of shortening of phrases, a lot of different words for the same thing, and it's shortened to liabilities here. So this liabilities to non-shareholders is shortened to liabilities. But actually what it is liabilities to non-shareholders. And this is money out of the company. So money that goes out of the company in the future. If it would have already gone out, it would already be out of my bank account. So it could be bank loans. So we owe the money, we owe the bank money. Bank loans either a short-term overdraft or long-term bank loans. Money that's going to go out of the company. We've got to provide this money out of the company over to the bank. Or it might be something that we've received some goods on credit. So our suppliers have given us some goods. We've already received them. They've not actually given us, we owe them the money. We haven't paid them the money. We've got that money going out in the future to those suppliers. Or it might be something that we owe in tax. So you might owe some tax on our salary, our workers' pay that we've given them. Or alternatively, we've got some tax in terms of on the sales that we made, VAT, or some other form of tax that's been put in place. And it's there. So money that goes out in tax, let's say. So you've got these kind of things, and this all a liability to non-shareholders is money that goes out of the company in the future to people who are not our shareholders. Okay, so money out to organisations or people that are not our shareholders. That's what a liability is. So liability is non-shareholders. Always seems to be is always shortened to liabilities, but it is liabilities, money out to people who are not our shareholders, and it goes out in the future. Now, liabilities to shareholders. You'll see because we have this is also shortened to capital or share capital. You'll also see the profit and loss account reserves sometimes in there. But basically, we've got to decide whether we've got money that's going to go out in the future to the people who own the company. So liabilities to shareholders. You'll see this whole series of different words used for this, but this is going to be our liabilities to shareholders. And it's going to be money out to the shareholders in the future. And those shareholders in the future, now put yourself in the place of those things. You've invested in the company, you own this company. So let's say you've handed over £100,000 and that £100,000 is sitting in the bank. And you shut the company. Well, you want your £100,000 back. So it's a liability going out to you. The company owes you the £100,000 back. Now let's say this company made some profits. So they made £10,000 worth of profits. So it's now got £110,000 sitting in the bank. Well, you shut the company. You want your initial investment back. But you also as well want all that profit. You're going to have the £110,000 back. So it's the liability of any profits that are made. Now, so you own those profits as well. You're not going to go to anybody else. You're not giving them to the staff members or to somebody from tax or whatever it is. It's your money. You made it in there. So you're going to take that back. You're not going to give it to anybody else. But also as well, if this company made losses, so we started off with this £100,000 that's sitting in the bank account, but it made a £10,000 loss, and you think you're going to shut this company down. Well, there's only £90,000 now that you can have. So you've lost any losses that you make as well. So this liabilities to shareholders, which is shortened to capital, is money out of the company to owners of the company, and it's going to be the initial investment and the profits that are made, and less any losses that are made. Okay, so it's like a liability. So it looks like a liability. isn't it? It's very similar to this sort of thing of money that goes out of the company, money out, a negative for the company. But instead of being a negative to the company of people who don't own the company, people like the bank or people from tax organisations or your suppliers, instead it's money going out of the company to people who own the company. So it's a liability to shareholders. So if you look at this from a point of view, the tip number one for double entry bookkeeping is that you must get this idea of being in the organisation, that you're actually this company, and this company is its own thing, in its own body, and it has its assets that it owns, its positive money, either in or in the future, its assets, but it also has these liabilities to people who aren't people who own them, and also as well it has these liabilities to people who own the company. So the shareholders are simply liabilities of the company. They're not the same as VAT, or they're not the same as suppliers, but they're just simply another type of liability that the company must pay in future. So you have these three different definitions of money. We've got this positive money in, and we've got this negative money out. Positive money in terms of assets, negative money out in terms of liabilities to non-shareholders and liabilities to shareholders. That's it. So what we're going to do now we've got our three pieces of paper, we're going to create something called the fundamental accounting equation. And this fundamental accounting equation is the thing that binds all of those accountants across the entire world and for centuries together. This one particular equation that ties everything together, and then everything flows from this. Okay, so this is the most important part of accountancy, and it's going to be the assets equals liabilities to non-shareholders plus liabilities to shareholders. That's it. That's the entire set of accountancy in one equation. Everything else flows from this particular point here. Now, tip number 2 in here, you lay it out like this. So it's assets equals liabilities to non-shareholders plus liabilities to shareholders, and this is the fundamental accounting equation. You may sometimes see occasionally that some sloppy lecturer or some sloppy book, a sloppy author in accountancy has fiddled this around and moved it around. And so it might say assets minus liabilities is equals to liabilities to shareholders. That's not the fundamental accounting equation. That is the financial position of the company. So it doesn't. It looks like this, and this is very important. And the reason why you do it like this, and this is why this is quite a fundamental point within accounting and the fundamental accounting equation, is because here on this side is all our money in, all of our positive money. This is important. Our positive money sits on this side. All of our negative money sits on this side of the equation, the liabilities to non-shareholders and the liabilities to shareholders. So our positive money into the company is always equal to our negative money from the company, and this is the fundamental accounting equation. And the reason why this works, so we'll sort of see that. So it always looks like that there. If you ever see it being fiddled around like that one there, so typically what you'll see is assets minus liabilities to non-shareholders. Assets minus liabilities is equal to liabilities to shareholders. Assets minus liabilities is equal to capital. If you see it like that, actually, that's not the fundamental accounting equation. And what you have then in that one, where they've messed around with it, is positive money minus a little bit of negative money is equal to a little bit of negative money. It's messy. It's not neat. It's not accountancy. That is algebra. That's mathematics. It's not the same subject. Quite fundamental, that really, in there though, and it's a very important distinction because accountancy was invented in the 5th century, and this kind of sort of approach with a number line is invented in mathematics in more like the 19th century. Quite a difference in between, and the accountancy method is far more superior from the point of view of organisation of financial accounts. So let's start with some financial transactions, shall we? That gives us a good idea about how we're going. So in every financial transactions, we've got some money coming in, this positive money. Okay, so we've got some positive money. It's going to be a plus sign. Okay, now this is a question of, this isn't now saying that in every financial transaction there's going to be an asset, a liability, and a liability to non-shareholders and a liability to shareholders. In every financial transaction, you've got positive money and you've got negative money. Okay, so you've got money coming in, which is positive money. You've got money going out, which is negative money. Okay, so you've got this positive and this negative in every single financial transaction that we do. And in accountancy, we're only interested in financial transactions. We're not interested in other activity in terms of, let's say, appraisals. That's HR. There's no financial transaction there. We're not interested in sort of a little bit of a chat or happiness, or the values of a company or whatever it is in there. We're solely interested with this in this double entry bookkeeping is in the numbers, the financial transactions within the institution. And within a financial transaction, you must have positive money and you must have negative money. Okay. So the positive money in and the negative money out doesn't have to be straight away. So you could be in the future. That's quite an important distinction in here. And most often it will be at some point in the future. Right, so why is it in this thing that the positive money in is always going to equal the negative money out? Why is that the case? Well, let's imagine that we've got a financial transaction and we've made a profit. And so the owners now, we've made this profit in there. Well, the owners are going to have this. Let's say you're the owner of the company. You want that profit. You might not want it now, but you want it in the future. At some point, you're going to close this company down, and you want back your initial investment and this profit. Okay. So all this profit really represents, the difference, the increase in your assets, the plus money in that you've received. All this actually represents is money that you're going to give out, the negative money that you're going to give out in the future to your to your shareholders. So all the profit, the positive assets, is offset by an immediate negative liability to your shareholders. So profits, any profit that's made, is always offset by a negative money out, a liability to your shareholders. So that's why it always adds up on the plus side if there's profits made. And so let's have it the other way. We've made a loss. So the company's made a loss. So the reduction in our assets, the negative point on our assets position after we've had this loss. So we've lost it all. So we work it all out there. When our bank account's gone down by £10,000, a negative amount in terms of our bank account or our debtors or whatever it is that's gone down by £10,000. Well, that's just offset by less money that we have to give out to our shareholders in the future. So this negative effect on our assets, this reduction in our assets, is offset by a positive improvement to the amount that we have to pay over to our shareholders. So that's always going to balance. This fundamental account equation, assets equals liabilities to non-shareholders plus liabilities to shareholders, assets equals liabilities plus capital, is always going to balance, because any profits that you make is always offset by liabilities to shareholders. Any losses that you make is always offset by a reduction in the amount you have to pay out to our shareholders in future. So that's it. That's how it all works. Now, hopefully you will have got that sort of concept in your head in there, and you can sort of see it on your 3 pieces of paper. Now, what we're going to do though is we're going to go through the way in which things used to be done, sort of 25 years ago when I was sort of training. The way in which we used to do it, which was we're going to sort of write out some financial transactions, and you'll see how this works. So what we're going to do is we're going to start the business, okay? And you're going to be the owner, let's say, and you start the business and you give the company £100,000, and the company puts that into the bank. Right? So what is the positive money in, and what is the negative money out? Okay. So what we're going to do then is now you've got a whole series of cups. Step 1, you're going to decide which is the money in cup and which is the money out cup. You're going to label it, or you're going to put it on your sheets, and then I'll put a little name underneath it. So we've got a bank account here on the one hand, and also we've got our share capital on the other. So we decide which cup the money is going to go into. So we name our cup. So we've got this bank account, and we've also then got this share capital here. So share capital is the money that we're going to have to give the shareholder, and then the money that the shareholders sort of put into the company, and they're going to want it back eventually. So we owe them it. It's a liability to our shareholders. That's going to be the share capital cup there. And the bank, well, we pay this money into the bank account. There's positive money there in the company, isn't there, in the bank account? So we've got positive money sitting in our bank account, and we've got share capital sitting that we owe them in another cup as well. So, and what you sort of see quite often within this thing is one of them you'll get early on. So it's well, okay, look, I've got this positive plus money in here, £100,000 in the bank account. So that's going to be my positive money. Well, the negative money then, well, I owe this money to somebody. Well, it must be the shareholders. They're going to want it back if I close this thing. So the negative money is the share capital. And so often you'll see sort of two sides to transactions. Or well, I definitely have two sides. They might be made up of more than one thing on each side of the transaction. But you have this idea. You get the one that you feel most comfortable with, and then it usually throws out the one that you're a little bit unsure about. So we're going to label 2 cups as these accounts. So one's going to be the share capital account, and one's going to be the bank account. There you go. There's my little labels sitting on them. You don't necessarily need to put labels on there, but just make sure that you got those things there. I've gone and taken all the various cups around. And we're going to put the cups on the correct pieces of paper. So the bank account is money that the company owns. So it's got money, it's positive money sitting in the bank account. There, positive money that the company's got right now. There. So remember, assets are positive money right now or positive money in the future. So you can put the bank account cup on the asset sheet. Share capital is a liability to shareholders in the future. Those shareholders handed over £100,000 in there, though. Yes, we put it into the bank account, so that's our positive money in the assets in the bank account on our asset page. But those shareholders want that money back in future, so it's a liability to the company in the future to the shareholders. So that's going to go on our liabilities to shareholders page. So there you go. That's how it's going to look. Okay, so here we have our bank account sitting on our asset sheet. And here we have our share capital sitting on our liabilities to shareholders sheet. Okay. Now we're going to put the money actually physically in the cups. Okay. So this is called posting a journal. Right. So we create a journal and we post it. So actually what you're going to do is you're going to physically post this journal. So we've paid £100,000 into the bank account. So that's money in. Okay. So that's positive. So put plus 100,000 on that piece of paper and put it into your bank cup. Like that. Okay. Now the shareholders gave us £100,000 and they want that money back at some point in the future. So that's going to be money out. So that's negative money. Right, so put 100,000 minus £100,000 on a piece of paper and put that into the share capital cup minus 100,000. Okay. So you already see that we've got plus 100,000 in our assets cup in our bank account, and minus 100,000 in our liabilities to shareholders cup. Okay, so that was our first journal. Bank plus 100,000, share capital minus 100,000. And you can see how the fundamental accounting equation is already working. Our assets is equal to our liabilities to non-shareholders plus our liabilities to shareholders. We'll sort of get down to that one. We've got this little balance thing going on. Right, so let's now buy a van for £30,000 from funds from the bank account. Okay. So the positive money item is the van, isn't it? That's what we're going to use. We're going to drive this van around and we're going to make some sales and whatever, and we're going to use that and make money in the future. So that's our positive money, our plus money. The negative money is that, well, we had a reduction in our bank account, haven't we? So we've got minus money going out of our bank account. So we've lost now £30,000 from our bank account, which we've taken out of the bank account, and we've put it in, and we bought it to buy the van. So we're going to create the cups. Well, we've already got the bank one, but we need a new one for vans. And the van's going to be a positive money item, so it's on the asset sheet, isn't it? We're going to use it to create sort of money in the future, so it's going to sit on our asset sheet. So here the journal is, the positive money item is the van, isn't it? So we're going to physically put into the van cup 30,000 plus £30,000. And the bank account's gone down by 30,000. The bank's our asset. It's positive money, isn't it? So it's going to be a minus item going into the bank account. So minus £30,000. So we put that little minus here in front of that 30,000. It's just gone slightly over the line, but that little minus would sit in front of that 30,000. So minus £30,000 goes into the bank account now. Put those in your little pieces of paper and pop them into your cups. Okay. Right. So that's the second journal posted. The company now employs someone and they pay them a month's salary out of the bank account straight away. Right, so they've employed somebody, and so we now got something called, we've got some salary expenses. Okay, and we've paid them out of the bank account £2,000. Okay, so we need another cup, and we're going to call that salaries. I'm going to put the label on the cup, but where are we going to put it? Okay. Well, the shareholders own this profits and loss of the business, haven't they? So the sales, they want to take the sales out of the business. If they make any sales, or whatever, the money that they get for the sales, those are going to come out of the business, and they're going to want that money back. But any expenses, well, that comes out of those profits that the company makes, or any it creates any losses or whatever. So the shareholders get that one as well. So the shareholders get everything that's called sales and expenses. So they get all the sales, but they get taken off from the amount that goes out to them all of the expenses. So the sales and the expenses go in the liabilities to shareholders sheet. So here, excuse me, the positive money item is the reduction in the amount that we would pay the shareholders in future expenses. So the salary. So you put plus 2,000 in the salary cup that sits on the liabilities to shareholders sheet. The negative money will be the reduction in the bank account, our assets. So we put a minus 2,000 in the bank cup. Okay. Now let's see what happens if we make a sale. So we're going to make a sale to a customer for £10,000. It requires us to go and spend £3,000 of purchase of goods, so something called purchases, to complete the order. So, and we're going to use this person that we paid £2,000 to. So we've actually made a profit here, haven't we? We sold something for £10,000. It cost us £3,000 worth of purchase of goods, and we got £2,000 worth of labour. So we've got a profit of £5,000 here. So the customer does not want to pay us straight away, and we don't have to pay for the purchases straight away either. Okay. So what happens here? So we're going to have 3 new cups. So the sale to the customer is a sale, isn't it? And the shareholders will want that money eventually back from them. It's a sale that the company's made. You know, it goes towards their profits, and the shareholders want that sale back in the future. So there's something called sales. Because the shareholders want it, or it's deducted from the shareholders thing. Then I'm going to we're going to put it on the amount sold to shareholders page, and that's where our liability to shareholders will be for sales. The customer does not want to pay us straight away, but they will pay us in the future. So that's going to be money in the future, isn't it? So that if the sales was money out in the future to the shareholders, the customer money in, the amount that they owe us, is going to be positive money, isn't it? They're going to give us that in the future. It's not going to go into a bank. It can't be in it's not in our bank account yet because they've not paid it to us yet. But they're going to pay it to the future. Because that's positive money in, the amount that they owe us is going to be a plus, isn't it? And it's going to be on our. It's a plus, so it's an asset. So the positive money item to the company, so it's going to be an asset. So it's going to go on this sheet. Now, as I keep saying, accountancy is a very old subject, and you're going to see a lot of different words for the same thing. So customer money that they owe us, so the amounts that the customers owe us, they could be called trade receivables, they could be called trade debtors, it could be called customer accounts, it could be called debtors. Anything like that, you just have to look at it and sort of see what it is. But if it's all the same thing, the customer owes us £10,000. That's positive money in the future, so it's going to be an asset. Okay, so what actually happens here then? So on that one then, so we've got this minus 10,000 that we would pop into something called sales, which sits on our liability to shareholders sheet, and we've got this positive £10,000 that we're going to pop into a cup, which sits in terms of, we'll call it trade receivables, and we're going to put that on our asset sheet. Okay. Now the purchases of goods that was in this order, this £3,000, is an expense, so it's a bit like the salaries. So we have a minus an amount, a positive amount here because we've got less that we have to pay out to our shareholders in future. So they take the losses and then they take their expenses. So we put a purchases cup on the liabilities to shareholders sheet. So we put that on our liabilities to shareholders sheet, call purchases, and we pop into there plus 3,000. Now we didn't pay for those purchases yet. We owe our supplier for those purchases. So that's going to be money out in the future. And those suppliers, those people who give us those goods, they don't own the company. So it's not liabilities to shareholders, it's liabilities to non-shareholders. So you've got a cup that's going to be our liabilities to our purchases, and it's going to sit on our liabilities to non-shareholders sheet. And in there we're going to pop the money out, the minus 3,000 on that one. Okay, so it's money out in the future, so it's negative money. It's not somebody who owns the company, so it's to non-shareholders, so it's a liability. So you put this cup, the purchases cup, on the liabilities sheet, and you pop into it minus £3,000. Now it could be called, again, a whole difference of things in there. So trade payables, trade creditors, supplier accounts, creditors, anything like that. Now we're going to call it trade payables. So that's what we're going to have here. So we've got our van that we bought, didn't we? And we bought that for £3,000 in there. Okay, and that came out of our bank account. We've got our bank account, and here we've been popping in the various sort of things that we've had going into our bank account. I think there was minus 2,000 for the salaries, wasn't it? We've got minus 30,000 for the van, and we've got £100,000 coming in from our shareholders. We've got this trade payables one in here. You need to sort of pop in your minus 3,000 into there. I've done this before I've actually popped them in. So we got that one in there. So you're going to pop that minus 3,000 into that one there. And we had those purchases, those costs to our shareholders. Now, so our plus £3,000 because our expenses to our shareholders went into that cup. And our minus £3,000 of money out in the future to our people who don't own the company going in that cup. We got these sales. We had that plus £10,000 in that cup. And we had this trade receivables over here. Sorry, this would be the plus £10,000 in that cup, the trade receivables, the amount that we would get in, the money in the future from our customers. And we have this minus £10,000 going to sales, which would be the money out to shareholders in the future when they want the money, they want their profits back. And so that's how this would work, really. So you're just going to pop these things into cups, and there, it's going to look like that. You post all the journals into the cups. So in the sales, we're going to have this amount that we carry over to our shareholders in the future. So it's negative money out, so £10,000 goes to the sales cup. So £10,000 into that cup, minus 10,000 to that one. And the customer is going to pay us in the future, so it's going to be positive money item, positive money, your money in the future, so the £10,000 goes into the trade receivables cup. The purchase represents an expense, which we can deduct from the amounts that we pay to shareholders in the future. So that's it. So any expenses, we can deduct it off the amount of the shareholders, amounts we pay to shareholders in the future. Sales, we have to add on the amount that we owe them in the future. Expenses, we deduct off. So it's a positive money item, so it's a plus 3,000 in the purchase cup. But we've got to pay for those purchases in the future. Those suppliers want to be paid for it, so it's minus 3,000 into the trade payables cup. It's money out in the future, minus 3,000, and that's going to be to somebody who doesn't own the company, so it's a liability to non-shareholders on the liabilities page. Let's get into another journal then. So the customer now. The customer of the one that we did a £10,000 order to, they pay the amount that they owe us. Pay that into the bank. So the positive money item is that the bank's increasing the money in. The money that we got has gone up by £10,000. So plus 10,000 going to the bank account cup. But the negative money is that this customer no longer owes us £10,000. So that positive money in the future has gone down. So that amount that they've gone is down. So there's a negative £10,000, and that goes into the trade receivables cup. So we have this positive money and this negative money. So we actually have here two cups on the asset page. And this is why you have to do this in this particular way and don't use any other shortcuts really that are provided on the internet. So we have this two assets on the same page. This positive money item, which is the money you're just handing over and going into your bank account. But then we have this negative money item, which is still in the asset cups in here, where we had positive money, we had future money, and we no longer have this future money. So it's gone down. So one goes up, one goes down. We're going to go now and pay the supplier from our bank account. Okay, so we're going to pay from the supplier from our bank account. We're going to give them £3,000. Well, the positive money item is that we no longer owe the supplier that £3,000. So the negative money in the future has gone down by £3,000. That's a positive money item. So we owe them £3,000. We no longer owe them £3,000. So it's plus £3,000, and that goes into the trade payables cup. The negative money item is that our asset, the bank account, has gone down by £3,000. So we have to post minus £3,000 into the bank cup. So you put those in there. And that's all that double entry bookkeeping is. The posting of positive and negative amounts of money into cups based on where they sit on our sheets. That's it. That's the whole thing. So you've just sort of seen it go through, and now we'll see sort of why it gets a little bit complicated. Why is it that students don't really like this? And this is because people usually start at the end and then work backwards, rather than as we've just done, which is start at the beginning and work forwards. So the positive money is a transaction that will always equal. So the positive money in a transaction is always going to equal the negative money. That's going to be it. That's the fundamental account equation. So now, one by one, empty out your cups and add them up. So if you just empty out your cups and add them up, and so on our asset sheet, we're going to have the bank, which will eventually be plus £75,000, which is the £100,000 of initial share capital minus the amount that we paid for the van, minus the £2,000 we paid to the staff member, plus the £10,000 we got in from our sales. Initially it went into trade receivables, and then they paid us for it, so we got £10,000 in there, and minus the £3,000 that we paid our supplier. Initially it went into trade payables, and then we paid them a bit later. So that's what we got in our bank account, plus £75,000. And our van is plus £30,000, and our trade receivable is now to zero. Initially it went up by £10,000 when we made that sale, and then the customer paid us, so it went down to zero. So our total assets, £105,000 plus £105,000. Trade payables is zero. We initially owed them £3,000 for the goods that we received, but then we paid them eventually, and that's so down to zero. Our total liabilities, therefore, are equal to 0. Our liabilities to non-shareholders is equal to 0. And the liabilities to shareholders. Well, we had this initial share capital of minus £100,000. That's what they paid us, gave us over £100,000. We put that in the bank, so plus £100,000 in the bank, and minus £100,000 the share capital, because we owe them that in the future. The sales are minus £10,000. That's in the sales cap. The purchases are plus £3,000, and the salaries were plus £3,000. So the shareholders, we owe them £100,000 there. We owe them the £100,000 for the sales that we made, but we can deduct off that our expenses, £5,000. So the amount that we owe our shareholders is minus £105,000. So, well, we owe them £105,000, and so it's minus £105,000 in that, from the company's perspective. Okay, so if we recreate the fundamental account equation, we've got plus £105,000 is equal to 0 plus minus £105,000. Right, so what we're seeing here then is, well, hang on a second, this isn't correct, is it? Plus £105,000 is not equal to minus £105,000. Okay, there we go. Now, why is this then correct? And the reason is because in accountancy you don't have a plus or minus sign. So you don't have this plus sign over here, and you don't have this minus sign over here. What you actually have is plus signs are called debits. So if you have a plus sign, whatever cup you put it into, a plus sign is a debit. That's what it's called. So there's no plus sign, it's just called 105,000 debit. And the minus sign is called credit. So there's no minus sign in this. So even all the postings that were put in there, though, there was no minus sign. It's called the figure with a credit next to it. It's really a minus sign in there, but in terms of how it was sort of taught, set out in accountancy, back in the 5th century, it was called credit. Yeah, so there wasn't a minus sign. This plus and minuses and the number line was invented in the 19th century. The plus and minus signs might came in there, but the number line came in the 19th century. Right? So what we've got really here is £105,000 worth of debits is equal to £105,000 worth of credits, and that's what is the accounting equation. And the reason why this is hard for students to understand is because people start with debits and credits first, rather than plus and minus signs, and then sort of try and work backwards, which puts a bit of a barrier in the way. So really what it actually is saying is that the debits equals the credits. That's it. That's all that's meant is assets, debits is equal to liabilities to non-shareholders, the credit lumps number 1, liabilities to shareholders, the credit lump number 2. Assets, assets equals liabilities plus capital, debits equals credits. That's it. That's it. That's the whole of accountancy there, really, sort of in one little sort of explanation. Basically, your debits equal your credits. Your assets equals your liabilities to non-shareholders plus the liabilities to shareholders in the end. So without a plus or minus sign, so let's say now we posted into our cups the amounts, but we didn't have a plus or minus sign in there. And then we got to the end and we tipped out our cups. How would we know what was in the cups in there? Seems a little bit strange, really. And also as well, to be honest, we're going to run out of cups in an accountancy firm, and it's not exactly the greatest plan in the world to keep putting things in cups. Really, is there a better way of doing this? Well, what we have is we have something called an account. So your cup is something called an account. That's all it is. Yeah. And what they actually laid out is, they're laid out as a big T. Okay, so that's why they're called T accounts. So they look like that. So this thing called a T account in here, and a bank account. So this is our cup, this is our bank cup, and here we have this thing with a big T. And what we do is you post your debits on the left side of this T in here. So your debits go on the left, and your credits go on the right. Now we're in the UK, so the debits go on the left so it's DR. You drive on the left, and if you drive on the right, you crash. Yeah. Don't think it really has the same impact if you're in America. I don't know what they come up with or what have you, or our European friends. But drive on the left, debit on the left, credit on the right. If you drive on the right, you crash. Okay, so that's an account. So we had a cup here. So our plus figures would go on the left hand side, and our minus figures would go on the right hand side. So let's see what happened there. So here, that's how it would lay out. We had our plus figure here, £100,000. We got a £10,000 plus figure there, and we got our minus figures on this side. Our debits, our pluses, our debits on the left, our credits on the right. We then balance it off. And in accountancy, we like to always check our figures. So we balance this off. So we make sure that we add all this up there though, and we have this sort of figure here, which is the balancing figure in there. So it's £105,000. So this bank account here really is debit £105,000 because it's just the balancing figure there, which is put on the credit side to just balance it. So this sort of really to get these to balance together, £105,000 would have to go into the credit side. So it's the total for this is a debit £105,000. So, and that's how it looks. So instead of putting them in little cups, because it would all look a little bit messy in our finance departments, we have these things called bank accounts, and they're on our pieces of paper, which is known ledgers, or would be in electronic form in here. In an electronic system, it would actually just be running with pluses and minuses, but in a paper-based version, which is what you're going to see, you're going to have debits and credits. And here's our plus amounts, and here's our minus amounts, and here is what it adds up to. And whatever it adds up to is always put on the opposite side to then just add it all up again, check it that it all works in there. That's it. Here's our van. There's our debit, our plus figure. This is the figure that we would have to need to get it all back to zero in there. And so that's how it looks. And there will be our trade receivables. And there's our trade payables. And our share capital here. And you can see how it's come onto the other side. This is now credit £100,000. And our sales, credit £10,000. And our salaries, debit £2,000. And our purchases, debit £3,000. Okay. Now, what we do then, a bit like when you shook out all your cups, we just extract all of those amounts from those big T accounts and we put them into something called a trial balance. So we just add them up, these totals of debits and credits in each account. The opposite side of that carried down figure. That carried down figure sometimes called carried forward figure as well. So that's how it would look. There's our trial balance. Here's our debits on this side. And here's our credits on this side. Here. And the reason why these carried down figures go there, because what happens is you're posting one to there and the other one to the trial balance. So here we have our figures of our debits. £110,000 worth of debits in total. And here we have our figures of our credits. And what I've done is I've put them on different colours for the sheets. And here, so you can see how this sheet in total was £105,000 minus £105,000 credit. This sheet here was in the asset sheet was £105,000 positive, a plus £105,000 debit. So this one £105,000 credit, £105,000 debit, and this one was zero. That's it. So T accounts, they're just cups or jam jars or whatever it was that you decided to pick in your method that you did it. Now, with positive money items going on the left of the T account and negative money items going on the right. That's it. An item on the left is a debit, what it is, and an item on the right is a credit. The best thing that I've seen from a student, although I'm not into tattoos really, is that they tattooed sort of debit on their left wrist and credit on their right wrist. However you get to make sure that it sort of sticks in your head, I don't think you should be going that far, but up to you. Right. Now, profit for shareholders just represents the money that the company has to pay out to the shareholders at some point in the future. So although profit might be considered to be positive and a good thing in there, though, from the company's point of view, all it represents is money that I have to pay over to the shareholders at future. So from a company's point of view, profit is negative money. And losses, that just represents less money that I have to pay over to the shareholders in the future as the company. So losses might be bad from the shareholders' point of view, but from the company's point of view, all they represent is positive money that I don't, less money that I have to pay over to shareholders in the future, so a positive position. And so as a consequence for that, sales are negative money items and expenses are positive money items. That's it. So the key tip there is you've always got to keep things from the company's perspective, and this is the point where students really struggle with, is that they can't get their head around the idea of profits being bad, or profits being sort of a plus position in there. They usually think profits being bad, and therefore it's a minus, should be a minus position. Actually, profits from the company's perspective are a positive position because they are less money that they have to hand over to the shareholders. If you can get that concept in your head, it makes everything else so much easier. Usually people think, well, losses are bad, therefore it must be a minus. Minus is a credit. No. Losses are less money that has to be paid out to shareholders, therefore it's a positive from the company's perspective, and therefore a plus is a debit. Now, last little tip for this one. If somebody ever mentions to you something called dead click, or something else, some silly anachronism, or something ever tells you there's an easy way to learn double entry bookkeeping in 4 minutes, and you see it on the internet, whatever, just if you ever mention any kind of this thing in here, just run, or stick your fingers in the air and go la la la, no, I'm not listening. And so there's two main things that I mentioned within this video really. One is, let's say, the Osborne book, which lays out the fundamental accounting equation incorrectly. It says assets minus liabilities is equal to capital. It's not. That's a statement of financial position. And the fundamental accounting equation is assets equals liabilities to non-shareholders plus liabilities to shareholders. Assets equals liabilities plus capital, because it has debits equals credits. The second one is, so if we see something like, let's say, the BPP book, that will have something like this dead click anachronism in there. So both books have this fundamental weakness within there. Don't ever go anywhere near it. Run a mile, because you will have to unlearn it. When you get to level 3 in particular, it's possible to pass the level 2 unit, the level 2 bookkeeping transaction unit, without actually really understanding double entry bookkeeping. So you can blag it, because you can do other elements of that particular unit and get those right and obtain a pass, even though the most important thing of accountancy you wouldn't know. However, when you get to level 3, the examiner will deliberately come in and spin you around a bit, in terms of there will be sales coming in and sales coming out. It's something called sales and sales returns, and there will be VAT on it, and there's a VAT on the sale return, and there will be errors put in, so the opposite way around. So you'll be spun around in there. If you try and use this kind of thing in here, that is designed specifically to make sure that you will fail. The way in which the exams are set out at level 3 will be designed specifically to make sure that you will fail, because proper accountants hate this. And proper accountants hate 4 minutes to learn accountancy as well, because you can't do it. It's an absolute nonsense. So, little final tip from Yoda. Dead click is the path to the dark side. Now, unlike Anakin Skywalker, the dark side will not make you powerful. It will make you incredibly feeble as an accountant, and you will fail at level 3. So don't go anywhere near it, and don't go anywhere near any kind of silly sort of 4 minutes to accountancy on the internet either. That's it really. Good luck. Let's leave on Yoda, as we always like to sometimes, in there, and hopefully that'll be useful. And I'll see you in class when we go through this activity as well. Thanks a lot. Thanks for listening. Bye bye.